Suresh Ganapathy joins us, Head of Financial Services with Macquarie Research. Suresh, I always love reading your extensive reports in the financial sector, and the latest one is in my hand, dated a day before Valentine, which is 13th of February. Credit cost normalization is the key theme for 2020 and 2021. So it's a very realistic kind of a scenario, but some would argue that when you see episodes like SBI giving money to Jet and NCLT not progressing the way we are assuming, the entire assumption of credit cost may get challenged.
Okay, so what we are arguing is that it is not that we are not going to see any slippages, right? So we are saying that you will have a slippage of about 2% of loans going bad every year. That's about 2 to 2.5 trillion rupees of assets going bad per year for the next couple of years. In that, obviously, you can assume a guy like, say, a Jet Airways, or for that matter, some of the SL group companies can go bad. But most of the large assets which have to go bad have gone bad. And therefore, we had a slippage of about, say, 5% over the course of last 3 years. So that run rate is going to disappear, or rather it's going to reduce. And the other important point which can drive credit cost normalization is the beef up of coverage ratio. So 2 years before, if you had asked whether credit cost would normalize, I would say definitely not, because the provision coverage ratio at that time was 40%. The last couple of years, banks have increased it to 65%. So you're not going to make any legacy provisions. So whatever provisions are required have to be done on incremental bad assets. So to that extent, obviously, your burdening on your provisioning rate actually reduces, and therefore credit cost is expected to normalize over the course of the next couple of years.
NCLT process will keep on chugging along despite the election cycle, because that is the variable factor, the election cycle and what happens to IBC and NCLT.
Sorry, can you repeat it? It's not clear a bit.
No problem. A key assumption is that the NCLT and IBC process will be strong. Now, do you think that is the joker in the pack, and the election cycle, in a sense, could have an impact on the NCLT process and the IBC proceedings?
No, I don't think so. Elections has got to do anything, or rather with the way the NCLT is working. It has a constitutional authority very clearly granted, by the current government, and irrespective of whoever is actually going to take charge, the courts will work at their own pace. Well, there is an issue of bandwidth with respect to the NCLT, because there are only 13, 14 NCLTs and there are thousands of cases pending. So that could obviously be a bottleneck, and obviously there are a lot of legal loopholes with cases guys like SR still exploiting. But then I don't see any derailment of the NCLT process happening just because elections are going to happen. It will continue at its own pace.
Suresh, morning. Have to talk about individual banks and individual stocks that you're recommending. And ICICI Bank clearly seems to be the darling of the street right now. Do you not think that that's getting a bit of an overcrowded trade? Because just about everyone and their uncle is recommending the same stock and owning the same stock within banks.
Yeah, I do agree with that, where clearly it seems to be a very consensus pick. But then look at it in this way: despite it being a consensus pick, the valuations are still pretty attractive, and people still there is skepticism in the fact that people still don't believe they can touch a 15% ROE that they have been guiding, right? So, and they've never had actually a 15% ROE in the last 10-15 years. So that's where the opportunity lies in, and consequently the re-rating in the stock. The stock is still cheap relative to where some of its peers, like even for that matter Axis Bank, is, and I think that will play out over the course of next couple of years. So we strongly believe in the fundamentals, and as and when ROE gets delivered, the stock has obviously potential to re-rate from current levels despite it being a crowded trade.
What about Yes Bank though? Is it finally out of the woods with Ravneet Gill at the helm, and finally a clean chit from the RBI when it comes to divergence? Although RBI believes that only part of the disclosures were made, but could that be a niggling worry at all for Yes Bank?
Okay, look, obviously the episode with the RBI is a pretty unfortunate one, and what is surprising is that there are other banks also have actually disclosed the divergence numbers, not exactly in the form of a press release, but at least in the analyst conference calls. So it's very unfair that Yes Bank gets singled out. Having said that, we can't take away the fact that the divergence is nil, and there were doubts about the asset quality and the kind of evergreening or restructuring or structuring arrangements that Yes Bank had in its portfolio. So that is put to rest. So there is greater confidence in its NPL numbers, or for that matter the book value. Valuations are still attractive. Yes, the RBI future penalties could be a cause of worry in the near term, but then it's all now going to be a function of the fact that how Ravneet Gill goes about turning around the bank, and obviously whether he is in a position to raise capital for the bank. So those are the key triggers which we need to watch out for in case of Yes Bank going ahead.
Right, Suresh, hi there, good morning. I'm just looking at the report and, you know, the subheader says, thank goodness the worst is over finally. Are you absolutely convinced that now the asset quality cycle, the kind of crunch that we've seen for the PSU banks, that credit costs which had been elevated are now going to normalize? And what really is driving this sort of a conviction? Because you know, there are reports and, you know, surveys that have been conducted that this overall liquidity crunch that we've seen in the space is only going to drag on into the coming quarters. So what really is driving this conviction?
Well, the first to begin with, the liquidity crunch may affect NBFCs more than the banks, and I think there is a temporary liquidity crunch for the banking system because the deposit growth is relatively weak, but I think that's just a timing issue because pre-elections currency in circulation has gone up, so liquidity will eventually normalize. So I don't see a big liquidity issue for the banking sector. It is more for the NBFCs than for the banks, and therefore I'd be more worried about the NBFCs because of the liquidity crunch. And also banks, if we were to look at it, their exposure, for example, towards commercial real estate and all is very small. It's about 2.5, 2.6%. And I think it's the NBFCs which have lent pretty aggressively to the commercial real estate sector. So I think some of the NPL worries that people are having could be more for the NBFC sector than for the bank sector because of the ongoing liquidity crisis. And as I already said at the start of the call, the two main reasons why credit costs will normalize even for them is the most large assets have been recognized as NPLs, and even public sector banks have beefed up their provisioning coverage ratio, and that is the reason I think the credit cost should normalize going ahead.
Now we've looked at one side of the balance sheet, we've looked at the NPA side. What about the other aspect, which is that, you know, for banks to grow they also need to lend, and if I look at the credit offtake number, the underlying demand, the feelers which I'm getting from an L&T, the feelers which I'm getting on the capex commitment, what Indians could do ahead of elections and where corporate lending is headed, somehow numbers don't stack up. So whereas there is extreme merit in believing that the NPL cycle has bottomed out, but that's part one. Part two is growth and uptick in demand. And you know, some of the banks are sitting on strong SLR and strong CASA, but if demand from the entrepreneur does not come through, what happens to growth?
That's true. So, you know, if you look at the report itself, rather our view itself, what we are arguing is that the earnings growth is going to be a function of slowdown or rather decrease in the level of provisioning, but not necessarily increase in the level of loan growth, or for that matter increase in PPOP as we call in banks, that is pre-provision operating profit. So earnings growth is not going to be a function of top line, it is more going to be a function of, as I said, reduction in provisions or credit cost normalization. So the PPOP growth is still going to be relatively weak. I mean, at best you can expect 14-15% because credit growth will be around 14-15%, predominantly driven by the retail sector. Retail still in India is growing at 18-19%, and I think that will continue. I don't see a reason why it should actually come down. And even so, for that matter, considering the last few years have been a pretty aggressive growth period for NBFCs, and some of the market share could move on to the banking space, and therefore retail will continue to do pretty well. And in the corporate sector, the working capital demand will be okay. The capex demand, as you rightly pointed out, is going to remain very weak. So you're not going to see a capex-led loan growth for the banking system, and there will be few opportunities in case of some groups which are in the bidding process for the NCLT cases. Like for example, what we saw it in Tata Steel or JSW or any of the other ones. So I think that will present as a significant opportunity for the entire banking system. And privates obviously have a story about grabbing market share from public sector banks and growing relatively well. So yeah, growth still remains, but there will be some pockets of opportunities here and there.
Okay, so closing comments, if one has to take a 3-year view and make a portfolio of private banks, but the composition could be good large NBFCs, or corporate banks or retail dominated franchise? What do you think will give you more returns? I'm not talking about growth here. Growth and return, we both know from a stock market standpoint, are different aspects. You know, stocks, good news does not translate into good stock prices going up, and bad news does not translate into stock prices going down. For someone who wants to make returns, what kind of portfolio composition one should have? Focus NBFCs, corporate banks or retail banks?
Yeah, sure. So, you know, in that context, one has to look at the various variables also, because, you know, we might have a different government. We never know what could happen in May 2019. So, we have to be pretty stock specific, and we need to have a very bottom-up approach. And in that context, I think from a 3-year perspective, I think it still makes sense to be heavily in private sector banks. Corporate or retail doesn't necessarily matter. In fact, I would say a healthy mix of both corporate as well as retail-oriented banks, private sector banks would be a decent portfolio to have. So, say if I have $100 to put, I would put reasonable amounts in ICICI, Axis and Yes Bank, and obviously the reasonable amounts even in HDFC, IndusInd and Kotak. So, the top 6 private sector banks will continue to do very well. The power of compounding story still exists in the retail private sector banks. They will still show a 20% earnings growth or a book value growth for the next 3 years, irrespective of actually who forms the government. And the reason why we are still not very gung-ho on NBFCs is because we still believe that there will be a course correction for them. I mean, from a fundamental angle, Reserve Bank of India could come out with certain kind of guidelines which can restrict their ALM abilities and obviously their funding patterns, and which could eventually affect their return ratios in the longer term. So, given that context, I think it makes sense to be heavily overweight the private sector banks, and I would of course not touch any of the public sector banks.
Suresh, great to have you on the show. Such a delight chatting with you and getting your view on the financials and banks at large. Good speaking with you as always.
Thank you. Pleasure.